Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to go over some Twitter information. I'll give you my opinion on a lot of different things. I'm going to talk a little bit about being an investor and not really much a trader. I'll talk a little bit about kind of my history, I guess. And you guys get to get some information out of me. You can look at me as a mentor, maybe. I'm not trying to say that I'm that great or anything like that, but I'm just describing kind of the difficulties and my journey towards being a successful investor. And I can talk about returns a little bit and what I've done over the past few years, how much money I've turned into other, amounts of money. I don't even know what the exact returns are, but I can go over that a little bit as well. But I wanted to talk about this right here, a setup that I see. And what I wrote here is the recipe for large gains equals extreme fear plus short-term poor fundamentals at the beginning of a paradigm shift. So what does that mean? A paradigm shift means that something large is shifting in the market. And what that means is you're going from a change in the business cycle where conditions change for investments. And the recipe for large gains is you need people to become fearful, and you want the short-term fundamentals to look horrible of what you're buying. And then you want, on top of it, a paradigm shift where assets are going to be repriced differently. That means that the structural conditions underneath the markets are changing in a way that is different from what it was changing before. So if you want outsized gains, what I mean by outsized gains, 10, 20, 30, 40, 100, 1,000 baggers. 1,000 is possible, but you got to really find that company, and it's difficult to get 1,000 bagger. It really is. But 100 bagger is possible. Very much possible. It's just not as possible with 1,000 baggers. So the way that you do it is you're going to have to think differently than everyone else. And that, for some reason, is very difficult for most people. And you're going to have to identify the conditions underneath the market and correctly identify those changing conditions. Because at the bottom of a market, what you usually get is a capitulation bottom where everyone gets fearful. They sell. That's that extreme fear. And then the fundamentals of the companies are going to look absolutely dire. Some of these companies should have high debt. They should be close to bankruptcy. And what happens is the assets sell off for pennies on the dollar. But what you are banking on is that paradigm shift. You're banking on the fundamentals changing dramatically and the market conditions rotating money into your assets. So the recipe for large gains is to buy things when they're down, to buy things when they look bad, in times of fear, and you want to do it when everything is about to change the valuations of that asset going forward. So looking at the profile here, this is my profile. If you want to follow me, Finding Value Finance, it's at finding_finance. I'm going to go over some things here. And what I'm going to do is I'm going to inject you my opinions. And this is where the money is made. All right? This is where the money's made. And the money is made when everyone tells you, why are you holding these things that are going down? That's the time to buy. You look at them in the face and you say, I'm going to take the opposite direction as everyone else. Because that money, we need that money to rotate back in. We need the people to sell first, where we take their shares from them. And then they have to buy back later at higher prices, where we sell them shares later down the road. So here is He says, here's a picture of how Joe Biden is manipulating gas prices lower in the short term and putting the U.S. in an increasingly vulnerable position just as global war probabilities are surging. Gas prices will soar when the manipulation ends and America will be in a weaker spot. This is the oil piggy bank. By October, the U.S. Strategic Petroleum Reserve will shrink to a 40-year low as the White House taps it to put a lid on global oil prices. This is us tapping that reserve. What everyone is looking at is they're looking at the price of oil and saying, oh, the price of oil is going down. Well, this is what it's taking to make it go down. They're tapping their strategic petroleum reserves and dumping it on the market. That's what it looks like. The big old SPR dump. That's what's holding the prices down. I am taking that opposite bet. Give me your shares of oil and energy service companies. Why? Because when this ends, they are screwed. There's going to be a very large difference in the market in terms of oil. They are dumping oil onto the market at this time at about 1 million barrels per day, roughly speaking. Well, guess what happens? If we get in a tight situation where they're dumping this on the market and all of a sudden 1 million barrels vanishes, what do you think the market's going to do? And we're at all-time low inventories worldwide of inventories and strategic petroleum reserve inventories. Well, the price is going to rocket. That's what's going to happen. The exact timing of that is irrelevant because I think it will happen irrespective. The timing, yeah, everyone wants to know the exact timing. You won't get that. Why? Because markets don't work like that. They're gonna front run this. They may not front run it. They may have news that comes out. They may do shutdowns somewhere in the world. We don't know the exact future. We don't know all the news that's going to be released. We don't know the extent that they're going to try to hold this all together. But the oil isn't there. They're draining the strategic petroleum reserves. We are going to go at it probably in 2023, maybe even the winter of 2022, because natural gas is going to be incredibly short this winter. Natural gas prices are going to rocket higher in America, and the world price is going to be very high this winter. They are going to substitute natural gas they're going to substitute oil for natural gas. So they're going to burn more oil, and that is not in the numbers. So when they release the Strategic Petroleum Reserve, and they're at very low inventory levels, if something happens worldwide where we start having natural gas crisis, which we will, we're going to run into shortages of coal, and then we're going to burn more oil, and we're going to be tight in all of these energy metrics. Eventually, people are going to turn and they're going to start putting on their nuclear plants. They're going to extend them or turn them back on. Then you're going to have a shortage of uranium. We're going to have a large energy crisis right in front of us. And at this time, we're going to have the lowest strategic petroleum reserves that we've ever had during the largest energy crisis we've ever seen. That is called peak stupidity. What they're doing is stupid because we are going to be more vulnerable to any sort of problem in the system. Here's this. The Biden admin is manipulating oil prices by draining the Strategic Petroleum Reserve by 1 million barrels a day. And an extra 20 million is dropping just before voting day. They're trying to manipulate this stuff, guys. It's absolutely moronic. No one has brazenly abused the SPR like this. Obama had a 100% rise in gas prices and didn't do this. They're being a little bit ridiculous with what we've got in inventory, especially since there's war going on throughout the world, war with Russia, who has, a main producer of oil in the world. It says, what QT? Excess liquidity between reverse repo and TSY cash balance, TGA, remains at record high $3 trillion. Where is this quantitative tightening? Don't know. Here's oil. Let the chart do the talking. All the chart is saying is when you get these circles, you want to buy in there. You want to buy. You've got support going across here, and you've got support coming from the long-term trend line. He drew it very much like I would draw it. And we could see a bounce here. We could see a bounce. We're seeing a bounce today, Friday. but we could see a much larger bounce than this. I'm not betting against that. We've got gold has massively outperformed since 2000 against the S&P 500. The S&P 500 is this guy. I started the chart at 2000, and here we are massively outperforming. Some people say never bet against stocks. Well, that's what I am doing. I am betting against stocks. Why? Because the market conditions that are coming ahead of us, inflationary environment, problems with the credit cycle, and problems with energy does not bode well for companies that are energy consumers. If you're short energy, you can't grow a company. If energy is expensive, it's going to raise the costs of everything. The root of the problem, in my opinion, is energy. And currencies are backed by energy. If the root of the problem is energy and your currencies are backed by energy, if you have a problem in energy, you could have a problem in your currencies. The currencies by design must grow. And if they can't grow because of energy constraints, you could see problems in currencies. Gold, I think, is going to show that there's going to be a problem, that you've got a problem with the currency itself in the number of debt units out there. And with that combined, an energy crisis, you could see problems, and gold, silver, platinum, any of the precious metals could go ballistic in these types of market conditions. I'm not saying that I necessarily know the exact timing of it. I think that is irrelevant. I think the timing is soon, but the exact timing down to the weaker months is not possible. As many people think and would like to know that you could just, a lot of these people who think they chart, oh, I can chart this. They don't know the future. They have a certain percentage probability of getting it right. I think the best way to do it is to store wealth in precious metals and not worry about the exact timing. Buy whatever's cheap. Platinum right now is cheap. I'm going to buy platinum. If something else is cheap, I'm going to own that. I'm diversified across gold, silver, and platinum. If something happens, I'm covered. Now here's platinum. Platinum looks pretty good here. Yeah, it's right down there. It's doing a back test. I think that this is going to go much higher. The path of how this is going to go higher, I don't know that. But we are above the cost curves. The cost curves are somewhere in the $700s, $800 range. That's perfect. And we're seeing all of these problems worldwide. Energy crisis, electricity prices are going berserk. South Africa, where the majority of platinum's produced, is having problems there. And if they have riots and problems because of electricity, and if their electricity grid goes down, you could see 80% of platinum come offline if it were to all get shut down for some reason. The risk here and the concentration of production in one country could bode very well for the price to go much, much higher, especially if you own the physical. Here's one. I'm confused about how and when we get total crude draw and total petroleum product draw, how everyone gets so bearish. October will be very interesting, and he's talking about when we end the Strategic Petroleum Reserve releases. It's going to get very interesting. That's why I'm in it, and I'm accumulating oil and natural gas. Saudi Arabia raises all oil prices for the U.S. for September. Interesting. So we've got the paper markets going down, but we've got Saudi Arabia and all these other countries raising the oil price much past $100 a barrel. Here's a guy, he says, not seeing solid evidence of demand destruction in the gasoline market. I don't either. I think he's from Piper Sandler. That's who it is, and company. It's an energy strategist. Where is the evidence of demand destruction? There is none. How is the prices going down? They're releasing strategic petroleum reserves, and they're probably messing with the paper markets. I don't care. Get me the exploration companies, get me the energy service companies. I'll ride it through. I don't care. We go down a little bit, buying opportunity, in my opinion. Here's Josh Young. It says, alternatively, the paper market is becoming irrelevant. And instead of physical premium, we should say paper delusion. The price of oil is what Saudi Aramco sells it for, not what traders trade it for. That's from Javier Blas and Doomberg. But we're starting to see this disconnect between the physical price and the paper price. They are paper manipulating every commodity that they can. This is an act of desperation, and they're at the end of this, guys. This is all going to break apart. And I'm not sitting here trying to trade a 20 or 30% trade. When this breaks apart, it could mean a complete repricing of certain things. I don't know what it's going to look like. I don't necessarily really care. I'm here to protect my wealth and to protect myself from them, the manipulators and the paper delusion, so to speak. Weekly oil inventory report from EIA. The implied demand looks low again. This should revert higher, and I expected to this week. They could be messing with these numbers for all we know. I don't necessarily know. And some of the demand numbers are like lower than they were many years before, and a lot of people are not really believing the numbers. I don't know what to believe, but I'm holding on to what I've got. And the markets aren't jiving with what I think a potential crash could be. If we see a crash, we should be seeing these numbers drop. They're not. And we should be seeing the 10-year yield really start to drop. And it's not. I am seeing irregular movements in the 10-year yield where we could see this thing really start to break to the upside. And the 10-year yield is highly correlated with oil and inflation. So I think there's manipulation going on across the board here. Wherever it is, I don't really care. I'm staying long. The 10-year yield is not telling me that a crash is coming. People are not running to bonds. They're running away from bonds, which tells me that a crisis in the dollar could potentially happen at some point. I don't think we're there yet. I'm not calling for a crisis, but I think it could lead to one if we see an uncontrolled sell-off in the bond market, which is uncontrolled yield spike. And they're obviously in there probably trying to control it. Here's a close above 1,800 seals the deal for gold. Are we going to get that close? We'll find out. Remember, the manipulators are trying to hold 1,800 things in the air right now. It's going to be impossible to hold all these things together. It's going to start to break apart. The markets are going to rule over it. And I think you're going to see their stranglehold on the manipulation of whatever they're trying to do start to fall apart. Here's URA. Looks deadly explosive here on the 1 hour. This is by Uselink, but we could break out of here any second to the upside. That's URA. That's a uranium ETF. Uranium looks really good. I think we've got a long-term bull market on our hands. Almost like Reality Matters. It says, Uniper says there's a run in Germany on diesel and diesel generators. Called it. Energy crisis equals an oil crisis. Oil demand's going to go up because of problems around the world. They are going to burn whatever they can. They don't care about the environment. They care about living and surviving a winter. We are going to run diesel and more oil and gas and whatever the heck we can get our hands on, wood, going to burn it. It says retail stocks are not leading the way. In March 2020, the retail stocks to S&P 500 ratio went straight up as the market bottomed on the back of an excessively supportive Fed. Not this time. Today, it's showing no signs of life as the Fed tightens conditions into a recession. Fed tightening and the retail stocks are not responding in relationship to the S&P 500. That is simply put a very good looking chart. He's talking about the GDXJ and the breakout to the upside. We should be looking at these stocks, guys. They are low, they're breaking down trend lines, and that's how you make money. How do you make money? A trend reverses, a trend changes. We get a bottoming pattern. We break the downtrend line. It goes sideways for a little bit. You can't base everything off price. You have to look at the pattern. You break a trend, then we invest in the new trend, the break of that trend. The downtrend's broken. Now we're going to have a sideways movement or an uptrend to follow. How you make big amounts of money is basically your contrarianness against everyone else. The least amount of people, when the least amount of people own something, that's when you want to own it. When everyone else owns it, you got to be out of it because that's the money that moves that asset. You need people to not be in it. You need to buy things when everybody hates it. But that's where, if you were to join the Finding Value website in the description link below and become a platinum member, that is what you will learn following me each week, going to question and answer sessions, watching those videos of the question and answers, watching what I post, what I buy, when I buy it, where I'm buying it, how I'm choosing these companies. I don't even choose the fundamentals I look at, but it's not even that important because the fundamentals change so much with the underlying commodity. What I look for are fractals. I look at the leverage of the price moves. I look at all of those things to maximize my returns over this bull market. If I think that oil is going to go up and I want to put a max leverage bet on it, I do an unleveraged, I'm not using margin. I'm not borrowing money. I'm not going into something that's super risky like options or anything like that. I go long a higher cost producer with a lot of leverage to the price move. Maybe they're highly indebted, and I'm taking a position in a highly indebted company where it got sold off to the downside, pennies on the dollar, and then when it reverses, it's going to be a highly leveraged move to the upside because of short squeezing, because of the leverage in the price move, because if they're a high cost producer and once it goes above that their break-even cost, it infinitely expands. It goes way down because when the price goes below a high cost producer's break-even point, it gets sold off to pennies on the dollar. That's your opportunity. That is what you need to know as an investor. You need to know where your cost curves are, where the break-even points are, where the price goes down, and then hopefully you get lucky. And there is a form of luck in this because you don't control the pricing of that commodity. You need the price to come back up above the cost curves. And if you think that the market's going to stay below the cost curves for a while, you better have a company that's not so leveraged up that they can survive the downturn. But the money's made at being a contrarian. The money's made at knowing these things. And if you want to mentor, if you want to follow somebody, definitely follow me. The platinum membership in the description link below is where I would sign up. Because then you'll know and understand what I'm doing and all the years that it took me to figure this all out. It took me years. And a lot of people, I think, look at the markets and come to incorrect conclusions because they form a narrative based off of what the price is doing. And I don't think you should do that. You need to form a narrative or a story based off of the market conditions and what's ripe for those market conditions to bear whatever fruit. High inflationary environment with an increasing interest rate environment will do well for certain sectors. That is what you need to focus on. The short-term price movements is noise in the system. And what people do is they'll look at the short-term price. It could pull back 40, 50%, and they'll say, oh, the bull market's done. It's like, no, it's not. The market conditions are still driving for this to go up. And historically, based off history, these do well, and they usually turn around at some point in the future, 5 to 10 years later. You need to know all that if you want to make copious amounts of money in the markets. So that's what I've got for today, guys. If you like the content, give me a thumbs up. Subscribe to the channel. Subscribe to the website below, Platinum membership. If you like and you want to learn about this, think of it as an investment in your education. And that is what's going to progress you forward. You need to know this stuff because you got to have the cojones to hold on to it if you want to make a lot of money. The hardest companies to make a lot of money in are commodity companies because of the volatility. They are very volatile. And in the beginning of a commodity bull market, you could see things that move around a lot. There are certain things or traits that you want to, there's certain strategies that you want to basically deploy and follow where you don't want to be buying at tops. If you get pullbacks of 30% or greater, you start cost averaging in. That could be a strategy that you can implement based off of the volatility of the stock. Maybe it's only 20% in some of these that aren't as volatile. But you can basically use those strategies. You can figure it out and you can see what I'm doing, copy what I'm doing. We've had actually a lot of really good picks here recently that we've picked off the bottoms and they're starting to come on up with some vengeance here. I mean, they're really starting to take off. So definitely worth it there. But that's all I've got for today. Hopefully you guys are having a good weekend and we'll catch you later. This is Finding Value.